Bollinger Bands are a popular technical analysis tool used to visualize price volatility and potential turning points in the market. In this lesson, you'll learn how these bands form a dynamic range around price and what their movement reveals about market conditions. Bollinger Bands help traders measure market volatility and spot potential price reversals. By visualizing the price range, they give you a way to assess whether an asset may be overbought or oversold, and that clarity aids better trading decisions. Before we dive in, let's quickly recap the key components of Bollinger Bands. Bollinger Bands are made up of 3 lines. The middle band is a 20-period simple moving average. That's your baseline. The upper band sits 2 standard deviations above it, and the lower band sits 2 standard deviations below. As volatility increases, the bands widen. As volatility decreases, they squeeze together. That dynamic movement is what makes Bollinger Bands such a powerful tool for reading market conditions. The middle band is a 20-day simple moving average, and there's a reason traders default to 20 periods. It matches a typical month of trading, which means it captures the short-term trend without being overly reactive to daily volatility. That 20-day SMA reflects the near-term trend and acts as the baseline for everything the bands are measuring. The upper band sits 2 standard deviations above it. The lower band sits 2 standard deviations below. Together, they form a dynamic range that expands and contracts with the market. Bollinger Bands are dynamic. They don't stay in a fixed range. When volatility increases, the bands widen, giving price more room to move. When volatility decreases, the bands squeeze together, signaling a period of consolidation. That expanding and contracting range is what makes Bollinger Bands such a powerful reading tool. The bands are always responding to what the market is doing, and learning to read that movement is what separates informed traders from those just guessing. When price approaches the upper band, it could be signaling an overbought market, suggesting a potential pullback may be ahead. On the other hand, when price moves toward the lower band, it may indicate an oversold condition, representing a potential buying opportunity. The bands don't give you certainty, they give you context. And in trading, context is everything. When price is near the 20-day SMA, it suggests a neutral market. There's no clear signal in either direction. The bands aren't expanding. Price isn't pushing toward either extreme, and the market is essentially telling you to wait. In this case, disciplined traders hold their position and look for confirmation of a breakout before making a move. The setup isn't there yet, and forcing a trade in a neutral market is how traders get caught on the wrong side. Knowledge check. Look at this chart showing the USD against the JPY pair. Price has just touched the upper Bollinger Band and is showing upward momentum. Based on this chart, what should a trader consider doing? Is it A, enter a buy position, expecting price to continue rising? B, wait for a pullback, price may be overbought? C, hold the position and wait for confirmation of a breakout? Or D, enter a sell position expecting a sharp reversal? You have 10 seconds to record your answer. If you need more time, pause the video. The correct answer is B. With price touching the upper Bollinger Band and showing upward momentum, a trader should watch for a potential pullback. When price reaches the upper band, it may be signaling an overbought condition. That doesn't mean the price can't keep going. It means the risk of a reversal is elevated and caution is warranted. If you chose A, entering a long position expecting price to continue rising, that's chasing the move. Entering at the upper band puts you in at the worst possible time if a pullback occurs. C, holding and waiting for confirmation of a breakout. This isn't wrong thinking, but without already being in a position. Waiting at the upper band still carries significant risk. Confirmation matters, but location matters too. And D, entering a short position expecting a sharp reversal. The upper band signals caution, not a guaranteed reversal. Jumping into a short without further confirmation is just trading in the opposite direction impulsively. When price touches the upper band, respect the signal. Let the market show you what it wants to do next. Now you know. Nevertheless, keep in mind that Bollinger Bands are a secondary indicator, meaning they should never be used in isolation. While they're powerful for measuring volatility and identifying potential reversals, combining them with primary indicators like trend lines, RSI, or the MACD helps confirm signals and improve accuracy. No single indicator tells the whole story. The most disciplined traders use multiple tools working together before they commit to a move. For example, combining Bollinger Bands with the RSI provides a powerful confirmation tool. If price touches the lower Bollinger Band and the RSI is showing oversold conditions, below 30, that's two indicators telling you the same thing. That alignment signals a potential buying opportunity. One indicator is a hint. Two indicators in agreement is a signal worth paying attention to. Conversely, if price reaches the upper band and the RSI is showing overbought conditions, above 70, that's two indicators pointing in the same direction. It suggests a possible selling point. One signal is a hint. Two signals in agreement is a warning you shouldn't ignore. All right, traders, here's another knowledge check. Look at this chart showing the USD against the EUR pair. Price is approaching the upper Bollinger Band and the RSI is approaching overbought territory. Based on what you see, what should you consider doing? Is it A, hold, waiting for confirmation of the trend? B, sell, anticipating a price pullback or reversal? C, buy, expecting price to continue rising? Or D, enter a short position expecting a sharp drop? Focus on where price is relative to the upper band and what the RSI is telling you at the same time. Let both indicators guide your answer. The correct answer is B, sell, anticipating a price pullback or reversal. When price is approaching the upper Bollinger Band and the RSI are simultaneously moving into overbought territory, both indicators are telling you the same thing. The move may be running out of steam. That confluence is your signal to consider taking profits or stepping aside. If you chose A, hold and wait for confirmation. Holding at the upper band while RSI is overbought means you're waiting for confirmation that may come too late. The signal is already forming in front of you. C, buy expecting price to continue rising. Buying into overbought conditions at the upper band is chasing a move that may already be exhausted. That's how traders get caught at the top. And D, enter a short position expecting a sharp drop. While the signal suggests caution, jumping straight into a short without further confirmation is still an impulsive move. There's a difference between not buying and aggressively shorting. When two indicators align at an extreme level, respect the warning. Now you know. Congratulations. You've just completed Day 20, Lesson 1. You now know the basics of Bollinger Bands, how they measure volatility, how to use them to identify overbought and oversold conditions, and how combining them with indicators like the RSI can enhance your trading decisions. That's a skill most traders never develop. And here you are, developing it early in your trading journey, before any real money is on the line. Remember, understanding these concepts is one thing. Applying them consistently is what builds real skill. This is exactly why simulators matter. Practice the signals. Make your mistakes now. Refine your process before real money is ever at risk. Up next, we explore squeeze patterns and breakouts, focusing on identifying low volatility periods and the breakout opportunities that follow. Keep growing. Now you know.
Ready to master trading psychology? Visit mmu.media and grab your free trading course. See how we teach trading the right way, step by step, with structure and clarity. Practice with purpose. Perform with precision. I'm Michelle, and we'll see you in the next lesson.